Thank you for joining us on this episode of Venture, where we explore investments within the built environment. Today, I'll sit down with Josh Green from Traverse Ventures, and we'll talk about how his firm plays a role within emerging technologies. We'll also catch up with Martin Roth from Zlien to talk about a recent round of funding that they just went through. But first, let's get into some recent financial news that's really making an impact. At the beginning of September, Fleetmatics made public their acquisition of Inosat, which is a Portuguese SaaS-based provider of fleet management solutions. The CEO of Fleetmatics, Jim Travers, said the company will greatly benefit from Inosat's influence in Portugal, as well as Spain and some other territories within South America where Inosat is having an emerging presence. InstaVR, which is a company whose product allows users to author, publish and analyze virtual reality experiences, recently raised $2 million in Series A funding. Now, one of three major companies to already start leveraging the VR platform is AECOM. And things you need to know: a couple weeks ago, we reported on Tesla's acquisition of SolarCity. Well, SolarCity is making financial news again. On September 12th, the company announced a $305 million deal with a private investment fund that's advised by Soros Fund Management. Genie Belt, which is a European product management and communications platform for the construction industry, has secured 2 million euros of new investment. The co-founder of Genie Belt, who's Klaus Nygaard, is optimistic about the company's future. As he said, there is no other European con-tech company in the workflow category that has managed to get to this stage. At the end of August, India-based home design startup LiveSpace announced raising $15 million in Series B funding. That means in less than 2 years, the company has secured more than $27 million, with three major investors being Bessemer Venture Partners, Jungle Ventures, and Helion. Now, let's get with our special guest, Josh Green from Traverse Ventures. Josh, can you tell us a little about yourself, and then go ahead and segue into telling us the background of Traverse?
Sure. Good morning. So my background: I've been a venture investor and an entrepreneur for about 15 years now, both in the clean energy industry and for the last 4 years in really real estate technology and construction technology. Traverse is the latest venture that we've launched, which is really a unique investment platform that's exclusively focused on investing in the technologies and the companies that are transforming the built environment. It's really an outgrowth of the work we've been doing for the last 4 years on the back of one family-owned real estate company based in Washington, D.C. And we started this business in 2012 because we really saw a disconnect between the abundance of proven technologies that could have a material impact in the built environment in increasing productivity, increasing profitability, but that weren't getting adopted for a variety of reasons. And we saw that the startups were having trouble, one, attracting financing. The generalist VCs were not that interested in this sector. And second, they weren't sure about how to access a pretty closed and conservative market in terms of the real estate owners and operators and the construction companies. At the same time, those companies were facing a deluge of different technologies, often similar sounding solutions that were claiming to do the same thing. They didn't have an in-house team to really understand which technologies did what, and for that reason, they were often putting off buying or adopting technology. So we saw an opportunity really to be that value-added intermediary, and Traverse actually is the name we picked to really connect those two worlds and get across the chasm so that we can invest in companies and help our limited partners, our investors, who are mostly the leading real estate and construction companies in the country, get access to these technologies and really help the startups then access that market.
I definitely think that it is great that you're adding that connection, because I think most people in the industry can agree that it just isn't there all the way. So I think that's great. When you are looking at factors, or when you're looking at startups, like what factors does your fund consider when looking to invest?
Yeah, so like any venture capitalist, we really focus on what is the pain point that the product or technology is solving, what is the market opportunity, so how big is that pain point, how is it being felt, We're looking at the traction in the company. So Traverse doesn't generally invest in seed rounds. So we want to see a company rather than something that's an idea that's just taking formation. We want to see something that's already been sold. The customers are receiving real value from using it, the initial customers, and we'll call those customers and get a better understanding of that. It's important to us that the team has some experience in that industry, understands the problem they're solving, and also hopefully has some experience building and scaling a company, managing a team. And then I think the other two things we really look for are one, who else is around the table? Venture is a business of collaboration rather than competition. So what other investors are in there? What other advisors? Who else can help that company? Because there will be a lot of needs as a company scales from a startup into a full-fledged enterprise. And then lastly for us, because of our unique model where we have, again, real estate companies, construction companies as LPs in our fund, and they're looking to us to help them source the technologies that can make them more competitive, we really look at how much value can we bring to that company. So we love situations where a company has a few initial customers, the product works, we're now looking to scale it, so how do we go from 4 or 5 customers to 20, 30, 50, and we can really help them do that, and so we can get in at a reasonable valuation and help build that company to a successful exit.
Well, talking kind of about these technologies, what are some of the emerging technologies within the real estate and AEC environment that's caught your eye and Traverse's eye?
Yeah, so we really divide the world into 4 different buckets, the way we kind of segment the market. One is something we call real estate productivity. And so those are companies that have better leasing software, better platforms to manage capital improvement projects, to get new intelligence and take kind of data out of multi-building portfolios and understand trends and benchmarking so that they can price properly. It's really all the technology that's going into making the business of real estate itself more productive. Then there's design and construction, and that's everything from worksite management and inventory management to componentized construction. We've made an investment in a company, for instance, this was in our first fund with the real estate company. We made an investment in a firm called Project Frog in San Francisco. They do componentized buildings, which means that they actually are manufacturing most of the building off-site in factories, flat packing it, shipping it to the job site, and those buildings go up much more quickly, saving the GC time and money. Another category we look at and are excited about is Internet of Things. So those are companies that have that are really transforming what was once kind of dumb equipment into smart connected equipment, such that you can take digital information out and compare it across buildings, and whether that's thermostats or equipment that can sense before problems with your HVAC equipment before it breaks down, kind of anything that is enabling data capture and then analysis and applying kind of big data analytics to it. We put into that category. We funded a very interesting company called N-Touch Controls in that category. They basically are a facilities management and energy management solution for small box retail. So think about fast food restaurants, Ann Taylor Lofts, those types of companies. And then the last category is energy infrastructure that we look at. And so that's one that goes a little bit to our background, because part of our experience as professionals has been in the clean energy industry. But there's a fundamental shift going on in the energy industry where value is moving from the center, which were the utilities and the distribution companies, to what's called the grid edge, meaning the properties are increasingly important to the grid and can actually harness some of that value for the property owner, for the benefit of the tenants, and we think that's a really exciting investment area.
Well, you talked about Project Frog, which falls, I could definitely see the direct correlation between that and the AEC. Why that particular technology? What was it about Project Frog that really struck your eye?
Well, we thought it was a very interesting concept. I mean, construction and all the real estate, has been an industry that has been a slow adopter of technology, which makes it both an enormous opportunity and one that we're very excited about, but also something that you really have to look at hard to understand whether you're getting into something that's going to take 20 years to develop or 5. with Project Frog, the company had a very interesting and compelling value proposition to offer. Their main sectors that they sell into are education and medical office buildings. And at the time we invested, they had won some very large contracts with some districts in California to build 20 schools at a time. Wow. They had executed several buildings, constructed several buildings for Kaiser Permanente on the medical office building side. And so there was real traction in terms of their core markets, and the value proposition to both the end customer that was getting a building at a lower cost, tighter specs, more efficient building, less waste in the construction process, more predictability in the timeline, delivery timeline. So the end benefits for the customer and for the GCs were clear. So we thought that all added up to something that was worthy of investment. And we looked at a few companies that were doing that in other segments, which we thought were more challenging, but we liked the segments they had chosen and invested in the company.
This is kind of an off question, but I know people in our construction industry will definitely be curious on this. Do you by chance know like the time frame that they were able to build, those 20 schools? Because as I think this is prefabrication, right? And that the whole
a lot of the building is prefabricated, right. Yeah.
So and the whole point of that is to build quicker. And do you by chance know? You may not know this.
I don't remember the exact number of weeks, but I mean, the buildings can be delivered in kind of 1/3 the time. Wow. And what is really diminished is the actual time required on site doing construction. So as opposed to stick-built construction and having to bring in all the materials, the building walls, everything arrives already constructed, right? So that the time on site can be a quarter of the time that it otherwise would be, and there's much less waste in the process. You're not doing kind of stick-built and having to do kind of custom work on site. So it's a much more efficient use of labor and the crews of the general contractors than otherwise.
That's incredible. Well, we're going to take a quick break. I know we're just getting started, but we're going to take a quick break. So viewers, don't go anywhere. We'll be right back. More with Josh Green from Traverse Ventures.
The project is only as good as the documents that we're able to provide, right down to the guy who's installing a light fixture.
In the old days, you go out to site and you look at the guys that are actually building the space. They're out there with the wrong set of drawings.
You can't have an architect doing their job over here, and the contractor doing his job over here, and the owner doing his job over here. You want everyone to just stop working in their silos and work together.
Not only does our internal team use Newforma, but then also our consultants. Sometimes there could be up to 15 or 20 different consultants working on the same project.
When somebody joins a project, they know exactly where to go.
Being able to give the end users the ability to take care of themselves was very beneficial.
We looked like rock stars in front of our client, just because we had our stuff together.
I'm here with Martin from Zlien, and we're going to talk about their most recent Series A funding. Martin, thanks for being here with me today. We're glad to have you in the studio. What we're going to talk about is that funding you received in June. And I believe it was from Altos Ventures, and it was a $5 million round of funding, which is awesome. In my opinion, I feel like that would be a pretty successful round of funding for a construction tech company. And so my question is, why do you think that was a successful round?
Sure. So we've had a lot of growth over the last 3 years. The construction market is ripe for disruption. There's a lot of people entering the market, and we have a really good vantage point on what the pain is as it relates to construction payments and really driving efficiencies through technology in that space. We've been a capital efficient company up to this point, and that round of funding was a decision that we made and the result of a relationship that we've had with Altos for many years, and they've kind of followed the story with Zlien, and they've gotten very excited about the potential for our company. And I think it was an interesting partnership and an opportunity for both sides, for us to fuel growth, continued growth, hyper growth, hopefully, or definitely, and then, you know, hopefully drive some significant change for the construction industry.
Do you think it also has a little bit to do with the fact that you know, most construction tech companies are focusing on the field, you know, what applications can be applied on the field, whereas y'all are looking more at what's going on in the office. How can you make those processes a little bit more efficient? Do you think it has anything to do with that?
I think it has a lot to do with that. When we look at the construction tech landscape, there's a lot of attention paid to the field. There's, you know, AR and I say AR, augmented reality. In our world, AR is accounts receivable, but in construction tech, a lot of focus on AR and using whether it's mobile devices like iPads or the phone to enhance collaboration on the project in the field. And what we see is there's a lot of collaboration and interaction that's not in the field, that's in the office, that's happening with accounts payable, accounts receivable, that's happening with the financial executives of the company and their customers. And the construction industry as a whole, as that vertical, is relatively slow to adopt technology relative to fintech and maybe some of the others like healthcare and even education. And so when we think about the opportunity for our company and we look at the trend of investments, I don't think that we're going to be the last one. I think you're going to see a lot of VCs starting to look toward the office and see where they can drive efficiency and innovation for a lot of the administrative tasks that are no longer necessary with the technology that's available.
So I know we just kind of focused in on the office part, but to kind of zoom back again, why do you think that VCs are looking at just tech companies within the AEC industry in general?
Sure. So I think it has to do with what I mentioned before about the construction industry traditionally being slow to adopt technology. There's you know, the technology adoption curve for every industry, and I think that the early and late majority in construction, it consumes a much larger percentage of the industry. And the reality is building buildings is really hard. And so a lot of these companies get very skilled at doing what they do best. And so they haven't really focused on driving efficiency through technology. And so what it's done is it's just created this gap, and there's going to be a rubber band effect in the construction industry. That's what I believe, is that as investment flows into the construction industry, as more companies come through with innovative solutions for the field or for the office, you're going to see some really big winners in that space. Nobody has won SaaS in construction. There's not in my opinion, and I think objectively speaking, there's not a clear SaaS winner in construction. Somebody's going to do it. You know, who's going to be the Salesforce of construction? It's left to be seen.
So with the money you just received in your Series A funding, what is Zlien's plans to kind of utilize that? What do you want to do with that money you received?
Sure. So we have a core product that is selling well. We're growing revenue at a very rapid pace, and so part of the investment is to continue to fuel that growth, to continue to scale the operation of that core business. So that's a large component with sales, marketing, and really building out that core function to be just scaled at orders of magnitude more than what it is now. The other part of the funding is to really fulfill the vision that we have from a product perspective and to build out some additional solutions that service other parts of the construction project that aren't exactly what our core business is. So part of it is, a healthy part of it is growth, and the other part of it is product and really fortifying the product that we have.
Thank you again, Martin, for joining us.
Thank you for having me.
And if you want to learn more about Zlien, you can catch it at zlien.com.
This land is your land. A land of innovators, hard workers, makers, visionaries, craftsmen, and doers. A land for those who build, those who believe in a better country. A country born in freedom, forged by blood and by sweat. A land built by the people, for the people. Together, building better.
Welcome back to Venture. Again, I'm here with Josh Green from Traverse Ventures. I just want to go into some news. So here, there's been lots of money flowing into drone technology companies. Yeah. AirMap received $15 million, I believe, in April, and then Drone Deploy in August received $20 million from Scale Ventures and High Alpha. So why do you think that is, and how does the fund decide when looking at drone technologies? How do they decide which one to specifically go with?
Yeah, no, it's a great question. I mean, I think why it is that the promise of drones and the benefits they can deliver to a whole host of industries, including real estate and construction, but also things as diverse as agriculture, insurance, law enforcement, they really are going to disrupt all those industries in terms of offering a way to, at a low cost, collect and analyze data that really couldn't be done before. And so it's a very exciting space. I think there will be some very large winners in that area. That said, I think making an investment is still tricky. I mean, one, it's because the sector is still very nascent, and so it's very early days. There are not even the kind of final regulatory environments that will permit and allow drones to perform these different tasks. We're still in an era today of mostly manned drones, and then the technology is going to unmanned drones, and what will that mean when you don't have a human operator? Right. And so I think one, the competitive landscape is still evolving, and the regulatory landscape is evolving. We're very early in the cycle, but I would also say that when you talk about investment in drones, that is a very broad swath of things. Mm-hmm. So it encompasses. And when you're thinking about it as an investor, you're like, well, where will the value be within the drone value chain? Is it the hardware providers who are actually making the drones? Mm-hmm. Is it the software people who are doing either navigation software or the data analytics software, or again, hardware on imagery and capture cameras? Mm-hmm. I mean, there are a number of different areas within kind of the drone landscape to think about. And it's something that we're looking at closely. We've spoken with a few companies. We're following it. We haven't made an investment yet, partly because we think it's early, mm-hmm. and also because I think we're still deciding for ourselves where in that value chain we think there will be a kind of a winner-take-all dynamic, mm-hmm. where you can really back a very large and scalable company. Okay.
There have been some pretty big acquisitions as well within the last year. Oracle bought Techstore, which was huge, and then Ritchie Brothers recently bought Iron Planet, which I think just last year was known as like the #1 most funded AEC tech company, and so that's big as well. What are those acquisitions telling venture capitalists?
Yeah, it's a great sign for the industry. I mean, we've seen other acquisitions as well, and that is always the question when you start mm-hmm. looking at a space to invest in as a venture capitalist, okay. is what is the exit? If I invest in these companies, A, can they attain scale and actually grow, and can one differentiate itself from the others? Right. But B, how do I get my money back, right? How am I going to get liquid ultimately? And as the IPO market is increasingly difficult, mm-hmm. and you see that even in the traditional venture space where you have companies electing to stay private a lot longer, the unicorns that have these very large private market valuations, mm-hmm. Even those and the companies that have invested, the firms that have invested in those unicorns are thrilled. They're marking them up, they're showing a very high valuation, and yet those guys still need to get liquid at some point. Right. So there's always this question, and I think the fact that we're beginning to see that there are acquirers mm-hmm. for companies in this real estate and construction tech space is a real positive for the industry, and it makes people realize that it can be an attractive area for venture capital.
So what happens to companies that get acquired? On your end, say if Project Frog was to get acquired, what then happens to your investment?
Yeah. Well, so we've had a few of our companies already be acquired from Fund 1. And, you know, what happens really depends on the acquisition. I mean, so you know, like with most answers here, the answer is it depends. You know, the ideal is that it's an all cash transaction, all paid up front, and that we're selling our shares and we get cash in exchange for those at a very high valuation, much higher than the valuation we invested in. And we, you know, then can have a real cash return, or realized return it's called, for our investors. In practice, a lot of acquisitions get done for either shares of stock, a mix of stock and cash. When there's cash on the table, there's often an escrow and a holdback that's put in place by the acquirer, who says, I want to make sure that some of the things you're telling me come to pass, and then I'll release the rest of that cash. So I'd say it's the exception, not the rule, that you as an investor get liquid 100% of your participation in cash day one. But you know, in some ways, any acquisition is a good outcome. But it really, how good, and even if it's good, depends on how much capital you've put in, at what valuations, and the structure of the ultimate deal.
Earlier, not in this one, but in your last answer, you talked about, and you put it more eloquently, but like, how long will it take to get my money back, basically. Do you have a time frame in terms of how long you like to sit on an investment before it does go public, or now more easily get acquired? Or I think that's an investment horizon, basically.
Yeah, I mean, so we, like most funds, have a structure to our fund that actually gives you an outside window for that, which is, you know, it's a 10-year fund, right? Most, not all, but most funds are structured as 10-year funds with what's called an investment period of 4 to 5 years, so that you're putting the capital out over a certain period of years, and then to the extent you haven't already realized returns, haven't already harvested the portfolio before that, you have 5 more years to harvest the portfolio, and by year 10, at the latest, everything should be sold or IPO'd or whatever, so that you actually have returned the cash to your investors. So like most venture funds, you know, we try and, when we make an investment, we are usually thinking about how do we get an exit in this company in, call it a 3 to 5 year time frame. That would be ideal. I mean, sometimes it goes longer, and sometimes it's shorter. I mean, we've had 2 exits that were in less than a year, very successful exits that happened in less than 12 months. That's the exception, not the rule. We were very happy, but so I think, you know, it varies, but really for us, 3 to 5 years is probably the target.
Okay. Well, based on your experience, just one last question: is there any advice that you would give people seeking investments right now?
Yeah, no, that's a good question. And I've gone through this 2 times as a venture-backed entrepreneur on the other side, so I've sat in those chairs and been there. I mean, I think, look, the space is rapidly growing, and there's more investor interest in it than I think there ever has been. And there are places like Built Worlds and others that are great places to meet other advisors, other companies, partners, meet investors. There are increasingly incubators that are helping those companies kind of get from the napkin stage, a good idea on a napkin, to, you know, a company. And so, I mean, I think, you know, the real advice is, I would say, you know the pain point you're addressing, get early traction. So raise as little money up front as you need to actually prove that you have something of value, that there are customers that you are solving a pain point and people will pay you for it. And then I think, you know, don't be penny wise, pound foolish when it comes to valuation. I mean, I think a lot of entrepreneurs, and again, I've sat in those chairs, and it's hard when you have to sell a part of your company. But I think the most important thing is not how much money you raise at what valuation, but who you're getting it from. And if you can get the right people around the table, and as I said, it will never be that one firm can take you all the way. It is a collaborative industry. But if you can get the right people around the table, your chances of success are so much higher And you're so much better off having a slightly smaller share of a much bigger pie than operating from a position of fear about selling your equity.
Okay. Well, thank you so much. It has been such a pleasure talking with you. I appreciate you for coming down to our studio and speaking with us. Yeah.
Likewise.
It's also been very enlightening, and I hope everyone has also thought that as well. Again, Josh Green from Traverse Ventures. If you want to learn more about the firm, go to traverseventures.com. And to catch more episodes of Venture and other Built Worlds programming, subscribe to our channel, or you can check out our website at builtworlds.com. Well, that's all I have for you today. So thanks, and we'll catch you next time.